Hi, and this is George Vlacker-Nicholas from Oxford Business Tutor, and today I want to talk about the share price. Now, in previous videos we've talked about shareholders and what shareholders want from life, and basically they want three things. They want voting rights at an AGM, they want dividends, and they want the share price to go up. But it's increasingly becoming clear to me that it's the share price that matters more than anything else. People these days want to buy into shares, see their value go up, and then sell the shares and make a tasty little profit, sometimes in quick time, sometimes very quickly, other times over a number of years. It depends on the shareholder. But let's assume that everybody wants to see their share price go up. So we better have a look at, well, what dictates the share price? Why do share prices go up and why do share prices go down? Well, I think then you've got to look at, simple economics, simple supply and demand. The supply, the number of shares is fixed, okay? It's fixed. There's always a set amount of shares in any one company. If I go and set up a company tomorrow with a bunch of mates, let's assume there's 5 of us, we might split up the number of shares and say give a share to each of us. 5 shares. There's 5 shares in that company. That doesn't change. There's always 5 shares in that company. And it's the same for a PLC. So when Facebook launched onto the stock market, I believe it had somewhere in the region of about 2 billion shares. Okay, so it could go in from anything from 5 shares at the lower end to billions of shares at the top end. You've got to get it straight in your head that the number of shares in a company is fixed. Now, in time, you'll begin to learn that the number of shares can increase at specific points in the business's life cycle. So perhaps as a business needs to grow and needs to take on more investment, then the business can sell more shares to new investors and bring them on board to get their money ready for that growth in the business. But bear in mind that those shareholders, particularly in a limited company, would have had to have agreed to that, and they will have had to have invited that shareholder on board, and they need to be cognizant of what effect that is going to have on their dividends. Excuse me. Similarly with a PLC, that's the sort of thing that'll get voted on at an AGM, so all shareholders will be aware of releasing new shares onto the market. They might even have a preferred option of buying those new shares, but they'll have all voted on it and they'll all know why they're doing it, and they'll all have accepted the sacrifice they might have to take in their dividend because profits are now being distributed over a greater number of shareholders. To come back to where we were, supply then, at least in the short run, in the very short run, is fixed for shares. Which means then, how does the share price change? Well, if it's not supply, then it must be the demand. The price of shares is purely dependent on the demand for shares, okay, whether there's high demand or low demand. And that basically means how willing and able people are to buy shares in this particular company. Well, it doesn't, have to be a rocket scientist to realize that if demand goes up, you have an excess of demand for shares at a particular price, that puts upwards pressure on the price and the price goes up. Same detail if demand goes down, there's an excess of supply in the market, so that puts downwards pressure on price and the share price goes down. Why share prices go up and down for different companies will depend on that company and will depend on the environment that company is operating at the moment. You might find it easy to categorize things into external factors and internal factors, and I guess what I mean by that is external, something that's in the control of the business. I said that wrong. External is something that's out of the control of the business, something that happens maybe in the environment. So let's take an example, maybe a BP oil spill. That's a kind of a natural disaster that BP have taken responsibility for, but nevertheless, it wasn't something they chose to do. It was a purely freak, it was an external accident. Okay, another one might be the Smiler ride at Alton Towers, with the Merlin Entertainment Groups that owns Alton Towers. Again, a freak, an anomaly, something big accident, huge PR disaster, and the share price goes down. Okay, people are looking at that and thinking negative thoughts towards the company. Let's break that down. Let's follow the chain of analysis though. Okay. People are looking at that and what are they thinking? Why does that therefore lead to demand going down? I think you've got to come back all the way to why it was that I had a share. I'm having a share because of the dividend and because of the share price. Both of those things are likely to change with profits. So when I'm looking at the BP oil spill or I'm looking at the Smiler disaster for Alton Towers, I'm analysing what does that mean for profits of those companies in the near future. Well, in the case of BP, wow, okay, they've got a huge cleanup on their hands and it's going to cost them a huge amount of money to deal with that. And if you think about how much that's going to cost them in comparison to their revenues, this ain't going to be this is going to be a huge blow to their profits, yeah, an absolutely devastating blow to their profits. So if I'm a shareholder and I'm thinking, wow, this company isn't going to be making a lot of profit in the near future, well, what's the point of investing now then, yeah? The demand for BP will go down because we're worried about its future sales. Same detail with the Alton Towers. They've had an accident, they've had a huge PR disaster, and you presume then that people will look at that and think, I'm not going to go to Alton Towers today, I'm not going to go tomorrow, and maybe you therefore expect that sales of Alton Towers tickets and people going to Alton Towers will fall. That will therefore influence their profits, and that therefore means that because you think their profits are going to go down, you're less likely to buy a share, and that will put downwards pressure on share prices. Look at it the other way around, okay? Look at it the other way around. If there's a particular reason why you think a company is likely to see an increase in profits, maybe they're launching a new product, yeah? Every time Apple launches a new product onto the market, its share prices seem to go up. Why? Because people are expecting to see an upswing in sales, an upsurge in profits, and therefore if the company's going to be making profits, they're going to pay very high dividends on these shares. So therefore lots of people want to own the shares and the share price goes up. Okay. Similarly, if it's not a new product, it might be going into a new market. Okay. IKEA, for example, have been in the news today about moving into their new markets. They're also becoming a big online retailer. Well, if you're looking at that, then you're thinking, wow, okay, they're moving online, they're moving into new markets. I can see that the sales are likely to go up in the near future. If sales are going up, that means profits likely to go up. Hey, if they've got a lot of profit, they'll pay a high dividend. I want to get involved in this. I'm going to buy a share. Demand for shares goes up, and therefore the share price goes up. Share prices can be dependent on a number of different things. It can be an external factor, it can be an internal factor. But the thing to get right is, how does it affect people's perceptions of whether or not this company is to be profitable in the near future? If you think the company is going to be profitable in the near future, then you should probably buy a share. If the company isn't going to be profitable, then don't buy the share. And if you're an existing shareholder, get out quickly, sell now. Perhaps the one thing just to bear in mind of this is it's all about expectations. Nobody really knows what the profit is going to be for any particular company next year or the year after. So this is all a judgment. This is all a gamble. This is all a risk. Nobody really knows. But if you think you know and you think you've got a better judgment than a whole lot of other people, then why not put your money where your mouth is and buy the shares and see if they get the growth that you're expecting? It's going to be a risk, but if you feel like you've got the inside track, then maybe go with that and do it. I would urge some caution, because obviously you don't know what other people know as well though. And you might think, oh, Apple's releasing a new phone in September, therefore, I'll buy the Apple share prices now in September. But there's a whole bunch of people that kind of predicted that 3 or 4 months ago, or maybe even a year ago, and they bought the shares way back then. So you've always got to be conscious of, have people already bought thinking about the thing that I'm thinking, in which case maybe the share price is already overvalued. Because you hear this line so many times, you've got to buy low, sell high, buy low, sell high. Well, yeah, in principle, it's a really easy idea. I'm going to buy the share value when it's low, then this thing's going to happen, the share price is going to rocket up, and I'm going to sell it. But that's really difficult to predict, and the truth is that nobody really can get that right for every single company all of the time. Okay? But if you think you can see something happening with a company in the very near future, and you don't think a lot of other people have seen that, then chances are that you should invest now, see their profits go up, and then the share price will go up as well. And that's how you make your money. That's how the share price changes. In the next video, we'll talk about why the share price matters and who it matters to. Good luck.